Good afternoon. How are you doing, Cameron? Oh, there's more than Cameron. There's Pierce and Joe and Kevin and Aiden and Luke and Ellie and DJ. How are y'all doing?
Good, how are you?
I'm doing great. Remember the issues we're having with my daughter-in-law with COVID, and she's pregnant and all? Well, yesterday she started having trouble with her liver. They don't know if it was COVID. They don't know if it was pregnancy and COVID or whether it was medication from COVID. I don't know. But anyway, she was hospitalized again yesterday. They decided to induce. And here this lady is my daughter-in-law's been about a month. She gave birth this morning to a granddaughter, got another granddaughter. And I cannot imagine being in labor on Pitocin, which is what they give you to make you go in labor, which is a hard labor, on Pitocin with pneumonia and COVID, and labored about 16 hours and gave birth this morning to another granddaughter. Her name is Sadie. So, God, I've been worried all night, but everybody's doing fine. I have gotten nothing about how Maria's doing other than she's okay, but don't know about the liver thing. So she's testing positive for COVID. Don't even know if she can be around the baby. We've only seen pictures of our son, John, who's my stepson, but I raised him. Anyway, excited about that. I'm looking forward to hearing something about Maria. And hopefully she can be around the baby, because I know she was planning on breastfeeding, but let's see. So anyway, grandbaby number 2, how are y'all doing?
Good, good.
Oh, guys, I was thinking I hear some voices. Don't forget to get started, if you haven't already, on your FSA project. I am going to can't tomorrow. One day, I'm trying to think of when it's due. One day next week, I'm going to have office hours that is for an hour that is only answering FSA questions. So look for that. It'll be on sign up. No, it won't. It won't even be up on Sign Up Genius, because you don't need to sign up. I will just push an announcement out to y'all. Boy, my Southern's coming out there. I'm gonna push an announcement out to y'all that of what time and what date it is, and you can just come and go, like we did for the exam, just open office hours. But you can ask other questions, but I want it primarily, it's going to be devoted to FSA questions. Okay, Peter. Oh, I thought you were coming in to say hello. Can I see some more beautiful faces? I miss all of y'all. Pierce, how are you doing? Are you going to stay with us the whole time?
Yeah.
Yeah.
I'm just moving something for my mom. Will be right.
Oh, yeah, that's right. When your mom comes through, is that? Oh, that's Peter. You said that? And Kevin, how are you doing?
I'm doing well. How are you?
I'm doing well, thank you. Have you been able to see the other K cubes to make the K square?
Kyle is here.
Pardon me?
Kyle is here.
Oh, he's there with y'all, with you.
Oh, no. I've just been talking to him.
Right, that's what I mean. Have the 3 of y'all been able to get together, or y'all just been able to Zoom or talk or text?
Yeah, just over the phone. I'm still in Florida, and then they're both back in New York.
Gotcha. And I guess the city's still shut down. I haven't watched the news in 2 days. I don't know. Maybe are we opened back up yet?
No.
I haven't watched the news in 2 days. Nope.
Not yet.
You did? So how are we doing on?
They don't even know.
They don't know?
So I don't know.
Do what, DJ?
I said they don't even know, so I don't know either.
Right. Just stay inside and be safe, huh?
Mhm.
Are you in Florida?
Yes.
Yeah. So I think in Jacksonville, up in North Florida, they opened up the beach. But that was a couple of days ago. Yeah. It'll be interesting to see if we get a spike again from starting to open up a little bit too soon. So, all right, today we're starting chapter 10. I know chapter 12, we didn't go over what the meaning of every ratio was, but I can read it to you or you can read it. So take a look and read at it, get started on it, on that FSA project. And one day next week, I'm going to have office hours where it is just office hours for this class for asking questions on the FSA. Have y'all been losing weight, gaining weight, or staying the same?
I have been gaining weight.
You've been gaining weight? Anybody else chiming in? I have been like the opposite, because I have friends that are all talking about, man, I'm going to be gaining weight, just like Alyssa. I have lost 5 pounds. Don't ask me how. But I've lost weight. Anybody else lost weight? Anybody else gained weight like Alyssa? Come
Probably a
on, y'all
little.
haven't weight. Y'all are afraid to know. Or y'all the like typical men and y'all just stay the same no matter what. Right? All right, so in chapter 10, we're taking a look at stockholders' equity. We had spent the first part of the semester learning about the financial statements and journal entries and adjusting journal entries. And then we moved on where we were looking at assets. And we focused on the recording for the different assets. Then in chapters 8 and 9, we looked at current assets, and then we got into long-term assets, particularly bonds. And then we took a little break over into the FSA project, and now we're getting into stockholders' equity. And when we first learned stockholders' equity in the beginning of the semester, we learned that when a company gets capital, equity capital from an investor, that we would debit cash and credit common stock. Well, now we see that there's a little bit more to the stockholders' equity account than just common stock. One is that we can have common stock. Companies can have common stock that either has what is called a stated par value, or it can have no stated par value. Now, what did you learn about what par value is? What is par value? On page 495.
What the stock is valued at, like over time.
Yeah, no, the par value has nothing to do with the value of the stock itself. Par value is something that came along, wait, hold on to this, even before I was born. And par value in the 20s, when Wall Street kind of started about, that par value, yes, at one point was to be the stated capital or kind of what the value of the stock was when it was initially sold. Well, when we had the stock crash in 1929, like I said, even before I was born, that there were a lot of companies that got sued because investors, lost money, obviously, in the depression and the stock market crash of. Does anybody know the year of the stock market crash? I already said, but have you learned it in your business history? It still lives in infamy. They still refer to it. 1929. I know, a long time ago. But the companies got sued because investors thought that they at least ought to get money back for what the par value was. So it was called its legal capital. Well, today, companies will still have, and this is on page 495, companies may, in their articles of incorporation, state that their common stock will have a par value, but because it's considered its legal capital and they don't want to be responsible for, if they go belly up, of having to pay the investors what the legal capital or par value of the stock was. Now, if companies do have a par value, it's like 1 penny or $1, something very, very small. So nobody really cares about it anymore except accountants. The only reason that accountants care what the par value is, again, what's called its legal capital, is because it tells us how much we credit common stock for. That's it. So you looked at page 495 and 496. And I want y'all to hold on to your horses because this is so difficult. I don't know if you can handle it on this. It's gorgeous here in Tampa. Gorgeous. Sorry if I'm making some of y'all sad, but it is stunningly gorgeous here. And you'll see how real easy it is. Are you watching me on the television, Peter? Yeah. That's what I would have done. I'd have hooked up to the television. I've been kicked back watching class on television, on TV. So, but what the par value does is simply tells you what to credit common stock for. So take a look at page 495 and 496. And that a company issued 1,000 shares of stock at $30 a share. So if it's $30 a share and they issued 1,000 shares, how much cash did they get?
30,000.
30,000, right? So they got 30,000. If the common stock is a no par value, meaning there's no stated value to it, then as we learned in chapter 1 or 2, debit cash for 30,000, credit common stock for 30,000. Now turn the page to the top of page 496. And it was the exact same thing, that they issued 1,000 shares of stock for $30 a share. So they were getting $30,000 cash. But in this case, the company's common stock had a par value or stated value of a penny. And how did the journal entry change? We still debit cash because we got cash, right? So we still debit cash for 30,000, but how much did they credit common stock for? 30,000 or
10.
10? DJ, how did they calculate 10?
They did 1,000 shares times the 1 cent.
Right, times the 1 cent. The number of shares issued, perfect, DJ. The number of shares issued times the par value is what you credit common stock for. So 1,000 shares at 1 penny a share is the $10 that DJ told us about. So then what do you do with the $20,990? They gave us $30,000 in cash because the value of the stock was 30. We credit common stock for the number of shares issued times the par value, and the 20,000 difference, the 20,990 went into this account that was called what?
Additional paid-in capital.
Additional paid-in capital. Additional paid-in capital. Us accountants, you know how we like to abbreviate everything and everything becomes an acronym. We call it APIC. Okay, APIC, get it? APIC. I'm so happy I got a granddaughter. So they call it APIC. Okay, you credit APIC. What kind of an account is additional paid-in capital, or APIC? What did they get? They got $30,000 for what? They got $30,000 because they had what?
Cash.
Right? They got cash. And who do they get the cash from?
Investors?
Good, investors. And when investors give us cash, what do we call it? Assets increase, and what else increases?
Stockholders equity?
Good, stockholders equity. This isn't tough, right, Aiden? You remember your accounting equation. So whenever we get investors, cash went up and stockholders equity went up. The only thing is that when there's a par value, instead of just crediting common stock, you credit common stock, and you also credit APIC, which is a stockholders equity account. A stockholders equity account. We're going to see that assets equal liabilities plus stockholders equity. And we've already learned, I don't know if y'all can see that, we've already learned that what's included in stockholders equity is common stock. Of course, we also learned about retained earnings. Those are the two different types of stockholders equity that we've already learned about. And now we've learned one that is called APIC, additional paid-in capital. Additional paid-in capital. Okay. On page 494, we see some very important terms. Authorized stock, issued stock, outstanding stock, and treasury stock. So let's talk about the first three: authorized, issued, and outstanding. Okay. Authorized stock is the maximum number of shares that a company is authorized to issue by its articles of incorporation. You know, when corporations start, they have articles of incorporation that list some rules that the corporation is going to follow. And one of the things, well, two of the things stipulated in the articles of incorporation are: one, is the stock going to be par value or no par value? And if it's par value, what is it going to be? A penny, a dime, a nickel, a dollar, $2? What is it going to be? And then, of course, they also will state what is the maximum number of shares this company can ever issue. Okay, unless they amend the articles of incorporation, but what can they issue? So that's what authorized stock is. Now, issued stock is the number of shares that have actually been issued, that have been sold in the primary market. In the primary market, okay? They have actually issued them to the investing public. There are two different types of markets. When we think about Wall Street and we think about the shares of stock that are being transferred and bought and sold constantly, just, you know, I used to say billions that were, you know, sold, you know, constantly, but now, right now, it may be millions. I don't know what's happening with the market either. I'm afraid to look because I'm too close to retirement. It was not a good feeling when the stock market did what it did. But anyway, there are two markets, sorry. When stock is initially issued between the company and the investors, that is called the primary market. The primary market. The primary market is when the transaction happens between the company and the investor. The company is getting the cash. Okay? Now, Alyssa and DJ. Alyssa and DJ, Alyssa has stock in Zoom. Okay? Stock in Zoom did pretty good when all this happened. So Alyssa had stock in Zoom, and she thinks that Zoom has hit its max and it's going to start decreasing in stock price. And DJ says, I don't think so. So I'm interested in buying Zoom. It's not at its lowest, but it's not at its highest either. So I want to buy Zoom. So DJ, now this is all through a broker. She doesn't actually meet Alyssa, but DJ goes out into the secondary market in order to buy stock from Alyssa. So when stock is trading hands between investors, the company is not involved at all. That is called the secondary market. Most transactions with stocks happen in the secondary market. In the secondary market. When companies issue stock into that primary market, they call it an IPO. What does IPO stand for?
Initial public offering.
Good, an initial public offering. An initial public offering. So when a company is going to first sell their stock, they're going to be issuing some of their authorized stock. They're going to be selling it in the primary market, and that is called an IPO, an initial public offering. So does everybody understand the difference between the primary market and the secondary market? I know when I first took accounting many years ago, and that wasn't before I was born, when I took accounting, I remember sitting in the principal's class and thinking, how can they debit cash and credit common stock when the transaction is happening between, you know, a person that already owns the stock and a person that's buying the stock? I could never visualize where the company was involved with that. And I had a wonderful professor that explained to me the difference between the primary market and the secondary market. And I was so glad to get that news to help me understand that. Okay. So when the company is involved and in the primary market is when the company is getting the cash and then issuing the equity. Okay. So authorized stock, the maximum amount of stock that a company can issue. Issued stock is the number of shares that the company has actually issued through an IPO in that primary market. Now, outstanding stock. Outstanding stock is the number of issued shares that are still outstanding to the investing public. Okay. So how would companies get stock that was issued to no longer be outstanding?
Buy back the stock.
Good, buy back the stock. And when companies buy back the stock, what do they call it?
Treasury.
Good, Claudia, treasury stock. Okay, so we also see now that we've got treasury stock in the equity section of the balance sheet, and treasury stock is a contra equity account. If it's a contra equity account, is it going to have a debit balance or a credit balance?
Credit.
What kind of a balance does equity have? Debit or credit?
Credit.
Credit. So if it's a contra equity,
It'll be debit.
exactly, it will be a debit. And we will see the journal entries because, as Peter said, treasury stock is when the company buys back their own stock. Okay? So a company has the number of shares authorized, which is the maximum number that they can authorize. Then they have the number of shares that are issued, the number that are issued. Okay? When you subtract treasury stock, because treasury stock is a contra equity account, when I subtract treasury stock, I get the number of shares outstanding. The number of shares outstanding. The number of shares outstanding are the shares that are still in the hands of the investing public. Treasury stock is the stock that the company has bought back, where they have bought back their own stock. Okay, so authorized, maximum number that the company can authorize. Issued is the number of shares that the company has actually issued in the primary market through an IPO. Outstanding shares is the number of shares issued minus the number of shares in treasury stock. Minus the number of shares in treasury stock. Okay? And then the difference between issued and treasury stock, so issued minus treasury stock, is outstanding stock, because that is the number of shares still outstanding in the investing public's hand. Companies only pay dividends on the number of shares outstanding. Companies only pay dividends on the number of shares outstanding. Okay? Because you're not going to pay dividends to yourself, right? You're not going to pay dividends to yourself. Another type of stock that we see, I already erased it, that we see in the stockholders' equity section of the balance sheet is preferred stock. What are some of the things that you learned about preferred stock? What is the difference between preferred stock and common stock?
Preferred stock, you can't vote on stuff.
Right. It's not that they. I'm gonna be careful with wording here. Your concept is fine, Aiden, but I'm gonna be careful with the word. It's not that they can't. It's their articles of incorporation stipulate that they can't. And I know that sounds like a tricky word, but another way to put it is there are some companies that have preferred stock that can vote. Okay. The majority do not. So one of the common characteristics of preferred stock is, as Aiden says, they don't vote. Preferred stock owners don't have, unless specifically stated in the articles of incorporation, which aren't usual, but they're non-voting. They cannot vote. What else is some characteristic about preferred stock?
They get priority on dividends.
Good, they get priority on dividends. When the BOD, the board of directors, when the BOD declares dividends, and notice I said when they do. BODs are not, BODs, board of directors, BODs are not required to declare dividends. Companies are not required to pay dividends every year. So if the board of directors declares a dividend, then your preferred stockholders are going to have preference on dividends. They're going to get their dividends before the common stockholders do. Okay, so typical things, they're non-voting. They're going to have preference on dividends. What else? What about preference in if the company's going bankrupt? Yep, they got preference over common stockholders also. What about cumulative and non-cumulative? Can preferred stock have the characteristic of cumulative or non-cumulative? Or they can't be both. They're either cumulative or they're non-cumulative. Does anybody know what that means? Look on page 497. John, how are you doing? You doing good?
Yep. Very good.
Good. Good. I'm glad that you are. I know that we've emailed or texted one another, so just seeing how you're doing. Miss Caitlin, how are you doing?
I'm good. How are you?
I'm doing good, thank you. My husband fixed some Spanish rice that's a Puerto Rican. Did y'all go to Puerto Rico or Costa Rica on spring break?
We went to Puerto Rico.
Puerto Rico. My husband cooked some Spanish rice from Puerto Rico last night, and I thought about the three of y'all on there. Isn't it weird, the little things that trigger in your heads, you know, when remind you of something? So what is the difference between cumulative and non-cumulative preferred stock? And what does it mean? Well, remember, I think it was Aiden that said that preferred stock is going to have preference on dividends, right? So one of the things that we're going to learn is the amount when a board of directors declares a dividend. We're going to learn how we calculate the amount that preferred stockholders will get. Okay, it's based on a stated percent and what their stated par value is. Okay, so we'll take a look at how we calculate that. So your preferred stockholders are going to have a set amount of a dividend that, if a dividend is declared, that they will get before the common stockholders do. Okay. Well, what if in 2019 the board of directors did not declare a dividend? So everybody was SOL. That's an official accounting word or acronym. What is SOL? Is it an accounting word? We're going to make it one, right? What is SOL? What kind of accounting word is SOL? What happens to the preferred stockholders when the board of directors does not declare a dividend?
Then they'll get priority for future dividends.
So they're SOL for this year, right? All right. And so the question is, DJ, do they get priority in future years? They'll get priority, but will they collect the amount? So suppose in 2019, the board of directors did not declare a dividend. So the preferred stockholders were just SOL for that year's dividend. Then in 2020, they do declare a dividend. Do the preferred stockholders get the 2019 dividend and the 2020 dividend, or do they just get the 2020 dividend?
They get both, right?
All right, DJ says they get both.
They accumulate,
Right, they get both if they're what?
declared.
I don't know who was saying, oh, Claudia, if they're what?
If they're declared,
Well, yes, if they're declared each year. So what if in 2019, none were declared? In 2020, they declared. So will the preferred stockholders in 2020 get 2019 plus 2020 or just 2020's dividend?
Just 2020?
Okay, so just 2020. I thought DJ said both.
Yeah, I did.
yeah, I think
Okay,
both.
DJ said both. Who was it that said just 2020?
Me.
Me, Aiden. Matt, what you think? 2019 or 2020? You know, both 2019 and 2020 or just 2020?
Just 2020.
Just 2020. Vincenzo, which one? Jay. Oh, there's Vincenzo. He has the audio. Okay, Vincenzo says just 2020. Matt, what you think?
I said 2020.
Oh, you said 2020. Sorry. Pierce, what you got?
Just 2020.
Just 2020. Joe. John, what you think?
2020.
2020. All right. So DJ, you're a lone holder. You're holding out there for the 2019 and 2020. I don't think anybody else agreed with you. And you know what? Y'all are all right.
Oh.
Because it depends. Remember, I was first asking, what does cumulative and non-cumulative mean? If it is cumulative preferred stock, DJ wins. Not that this is a battle. If it's cumulative, they would get both 2019 and 2020. If it is non-cumulative, then the rest of you are correct. They would only get 2020. So that is a feature that is on preferred stock. Is it cumulative or is it non-cumulative? Now, which one do you think is going to be more expensive?
Cumulative.
Cumulative, right? Because a lot of students will say, well, Dr. Bostic, why would they choose non-cumulative preferred stock? And I say, well, it costs more. And sometimes you just got to look at that cost benefit. All right. So cumulative is the preferred stockholders would get all of their, listen to the term I'm about to use, they would get all of their dividends in arrears. It is a funny word. I actually like to say that they have dividends in arrearage. Isn't that a fun word to say? So dividends in arrears. What is dividends in arrears? All these are just loaded on page 497. It's 2020, and we did not declare dividends in 2019. Is there dividends in arrears? Does this company have an arrearage? I like saying that word. So it's 2020, and they did not declare dividends in 2019. Are there dividends in arrears?
Yes.
Yes. So any time that a company has preferred stock that is cumulative, if it's non-cumulative, who cares? Other than the preferred stockholders. But if it is non-cumulative, if it is cumulative and they missed a year of declaring dividends, then there are dividends in arrears. This is not a liability on the company's financial statements. It's just a note, that they would keep in their files, a memo to the file. We didn't pay dividends in 2019, so we owe our preferred stockholders dividends in arrears. Okay, and you can see that term on page 497. Before we get too much further into this chapter, before we get into the treasury stock, chapter 10 is another one of those breather chapters. Chapter 11 is not. So let's look at, I want to work a couple of problems real quick. And let's look at problem 10. No, I don't want to do that one. Let's look at, we will in just a minute. Let's look at problem 10.3. And excuse me, it's exercise 10.3. And in the textbook, it begins at the very bottom of page 524. In the e-text, it probably begins on 525. Now I'm going to go into share contact. I'm going to go into share contact, and we'll do these real quick. Nope. All right, and y'all can start working it. I assume y'all can see my screen. I don't remember if you remember last week, I had to do it twice for some reason. And we are looking at exercise 10.3. Exercise 10.3. And it says, 1, record the transactions as if it was no par stock. And then number 2 says, what if it was $1 stock? Okay. So on January 1st, doesn't say what year, don't care. On January 1st, they issued, the company issued, Clothing Frontiers, issued 700 shares of common stock for $50 per share. Now, requirement 1 says this was no par stock. So this was no par stock. It had no stated value. So if they issued 700 shares at $50 a share, what am I going to debit?
35,000.
I'm going to debit what account?
Cash.
Oh, cash.
Good. And then if it's no par, what am I going to credit?
Common stock.
Good. Common stock. And because I'm doing this in Excel, they issued 700 shares at $50 a share. And is that what you had said? 3,500?
Yeah.
Cool. So they got 3,500. So they debit cash and credit common stock. Now let's go ahead and do number 2. What if it was a par value of $1? So it had a par value of $1. So I'm still going to get 35,000 in cash. And what would I credit common stock for?
700.
700. Good. How did you get that, Claudia?
The 700 shares times the $1 par value.
Perfect. We issued 700. It was $1 par value. So we credit common stock for 700. And what account am I going to credit?
Additional paid in.
Additional paid-in capital.
Good.
For
The
20
APIC, the additional paid in capital. Okay. I assume everybody knows that APIC is additional paid in capital. Additional paid in capital. And two of you were saying it at the same time. I think it was Claudia and DJ. At 36,300, if my math is okay.
Isn't it 34,300?
Yeah, it sure is. Woo. I was seeing if y'all are paying attention. So we see that with no par, it all goes into common stock. And with par, common stock is credited for the number of shares issued times the stated value. And then the remainder of it goes into this account, additional paid in capital. We affectionately call it APIC. And then on April 1st, the company issued 110,000 shares. And so if they issued 110 shares at $54 per share, then they got $5,940. And with no par, they would credit common stock for the same. Now, if it was $1 par, what would I credit common stock for?
110.
Good, 110. The number of shares I issued times the $1 par value. And the difference, look, I'm not even going to trust my own math today. The difference would go to your APIC. Right now, I want to work, before we get back into talking about the accounting for treasury stock, I'd like to go ahead and calculate where we pay stock on both to both common stock and preferred stock. And I'm trying to, there we go. Look at exercise 10.9 on page 525. So exercise 10.9 on page 525. So I'm on page 525, exercise 10.9. So we've got Power Drive Corporation that designs and produces golf equipment and golf apparel. And they have 100,000 shares of stock outstanding as of the beginning of 2021. And then during 2021, they had the following transactions. So the first thing is, let's record the transactions. So on March 1st, they issued 65,000 shares of $1 par value common stock for 52 a share. So give me the accounts. What accounts am I going to debit and credit before we get into the numbers? What am I going to debit?
Cash.
Cash.
Good, they got cash. And I'm going to also have to credit because they issued common stock. So I'm a credit
Common stock.
common stock. Now, was this stock no par or did it have a stated par?
$1 par.
Good, Claudia, it had $1 par. So what other account am I going to have to credit?
APIC.
I'm going to have to credit, good, the additional paid in capital, the APIC, the additional paid in capital. And the amount of cash that I got, they issued 65,000 shares of stock at $62 a share. So they got $4,030,000 with issuing 65,000 shares at $62 a share. Now, what are they going to credit common stock for?
65,000.
Good, 65,000. And then they will credit the APIC for the difference. Now, this exercise, I said I was going to teach you about treasury stock. Do an exercise and then we would do treasury stock. Well, this one has treasury stock. So let's go ahead and talk about treasury stock now. And then when we finish the problem, we'll have some more questions and answers about treasury stock. So on May 10th, the company purchased 6,000 shares of treasury stock for $65 a share. When we purchase our own stock back, we've already said that that was called treasury stock. And treasury stock is what kind of an account?
Contra equity.
Good, a contra equity. So is it going to have a debit balance or a credit balance?
Debit.
Good. So I'm going to debit that contra equity account called treasury stock. And what account am I going to credit?
Cash.
Good, because I had to buy it. I had to purchase it from that secondary market. And how many shares? We purchased 6,000 shares. Oh, I'm doing a Z test. Oh, Lord, no. 6,000 shares at $65 a share. Now, one of the things that I want you to notice is that although this stock had a par value, we ignore par value in treasury stock. When you record treasury stock, you ignore the par value. The only time that we care about the par value is when we first issue treasury stock, and that's the amount, when we first issue common stock, and that is the amount that we're crediting common stock for. When we either purchase treasury stock or when we sell treasury stock, we don't care about that par value. So the whole amount went into treasury stock, not the number of shares times the par value. So we debited treasury stock and credited cash for the 6,000 times the 65. And then it says that on June 1st, that they declared a cash dividend of $2 per share for all stockholders on record. Now remember, we only pay dividends on the number of shares outstanding. We only pay dividends on the number of shares outstanding, not the number of shares issued, on the number of shares outstanding. So let's see how many shares. I will do it over here so that you can see without me having to go up and down. Let's take a look at how many shares does this company have outstanding. In the instructions, it said that Power Drive Corporation does golf apparel and stuff. And it says Power Drive has 100,000 shares of common stock outstanding. So they had 100,000 shares of common stock outstanding at December 31st, 2020. And then they said during the year, they had the following transactions. Well, on March 1st, how many shares did they issue?
65,000.
Good, 65,000. So that increases the number of shares that we have outstanding. Then on May 10th, they purchased how many shares of treasury stock?
6,000.
6,000. So the number of shares outstanding or the number of shares, is it outstanding or, yeah. Oh, sorry about that. So the number of shares outstanding are 159,000 shares. How many shares are issued? How many shares does this company have issued?
65,000.
165,000. So this company has 165,000 shares issued, 159,000 shares outstanding. Now remember, we only pay dividends on the number of shares outstanding. We don't pay dividends to ourselves. So we had 159,000 shares outstanding. When we issue dividends, so on June 1st, they declared a $2 dividend for all stockholders of record on June 15th. And then on July 1st, they paid the dividend. Okay, they paid the dividend. When a company, what account are we going to debit? What accounts do we debit and credit? Let's just first talk about that when we declare a dividend. You learned this a long time ago. Remember debit dividend? Do you remember it's one of those, do you remember the three temporary account types? They spelled red: revenues, expenses, and dividends. So dividends is a temporary account, and it gets closed into what account does it affect? This is going back to chapter 2, chapter 1. What account does dividends affect? Ought to have that on the final exam.
Revenue.
No, that was one of the ways to fail the class, remember? Dividends are never, 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 ever an expense. What do dividends reduce? Okay, I know I'm gonna put this on the final exam. Do you remember the statement of retained earnings? Do you remember retained earnings? What causes retained earnings to change? My dear beloved students. We have beginning retained earnings. Okay, I'm gonna stop sharing. Y'all flipping me out. I'll be back. Okay, do y'all remember the statement of stockholders equity? And there was the column retained earnings. And you
Yeah.
had beginning retained earnings, and then you had ending retained earnings. What was in the middle?
Wasn't it red?
Yes.
Oh,
What does red stand for?
revenue, expenses, and dividends.
Good. Revenues, expenses, and dividends. And revenues minus expenses equals what?
Net income or loss?
Good. Net income. Good. So do you remember it was beginning retained earnings plus net income minus dividends equals ending retained earnings?
Yes.
Oh my God, am I having any semblance? I've got Claudia, I think, saying yes. Does anybody, oh my gosh, is this bringing back a foreign language here? Remember red, as
Yes.
Claudia said, revenues, expenses, and dividends. Good, Cameron's going, yes, I remember this. All right, so dividends cause retained earnings to go down. If it causes retained earnings to go down, is it a debit or a credit? How do you reduce equity? Debit or credit?
Debit.
Good, debit. Oh man, I see some things that are popping up on the final exam from just basic accounting, chapter 3. Okay, so dividends reduce equity. Remember on that adjusted trial balance that you prepared financial statements from, that dividends are a debit because they reduce equity. So I'm gonna go back to sharing my screen, and I'm gonna pretend that that conversation didn't happen, or that it happened, but y'all knew the answer. So dividend is a debit because we're reducing equity, specifically retained earnings. So we debit dividend, and then because this dividend was declared, it hasn't been paid yet. You read in the chapter that
Dividends payable.
good, credit dividends payable. Now, for how much? How much of a dividend did they declare per share?
$2.
$2. How many shares do we have outstanding?
159,000.
159,000. So 2 times 159,000 gives me my debit to dividends and credit to dividends payable. And we only paid it on the number of shares outstanding. We reduced the treasury stock because by definition, the number of shares outstanding is the number of shares issued minus treasury stock equals the number of shares outstanding. Now we'll continue on because this will is teaching you about recording for treasury stock. So on July 1st, the company paid the dividend. The company paid the dividend. You read that there are 3 dates that are important with respect to dividends. And what are those three dates? What are those three dates?
A reporting date?
The,
The date of declaration.
good, what page are you on, DJ? I'm looking for it. Date of declaration is one, yes.
Date of record.
Good, the date of record, yes. It's on page 504 and 505. So you have the declaration date, the date of declaration. That is the date that we did this, that was June 1st. On the date of declaration, that's the date that the board of directors declared a dividend. So it becomes a liability. It's a legal liability at that point in time. What is the date of record or the record date?
Like who will receive the dividends?
Right, it tells you who will receive the dividends. It is the investors on this date are the ones that are going to get the dividend. There's a lag between the date that they declared the dividend, in this case it was June 1st, and the date of record, because it takes some time for the transfer agents, or what they're called, to get a record of who actually owned the dividends on the date of record. So whoever owns the dividend on the date of record are the ones that are going to get the dividend. And it's after the date of declaration, after the declaration date. So on the date of record, there is no journal entry. That's just, you know, who owns the stock on this date. What problem were we working on? I turned the page.
E10-9.
Oh, thank you. I found it. So on July 1st, so the date of record was June 15th. Notice there's no journal entry. And then on July 1st, they paid the dividend. So what would I debit?
Would it be dividend payable?
It's exactly what it is. We reduce the liability, debit, and then we're actually paying it, so we will credit cash. And it will be for the 318,000. So the liability is reduced, and then the asset cash is credited because that's the day that they actually paid it. There is no journal entry on the date of record. I'm gonna stop sharing with y'all. I know we're working through this problem because it is incorporating several topics that are covered in this chapter, and they're just a bunch of short topics. I'm gonna stop sharing for a minute just to, I'm from Louisiana, and in case y'all didn't know that, how many of you did not know I was from Louisiana? I think it's kind of obvious, especially during Mardi Gras, right? So in Louisiana, we call something extra lagniappe. It's a French word, and lagniappe is a word that's used commonly in Louisiana. So I'm going to give you some lagniappe, something extra. If a company declared a dividend on June 1st, and the date of record is June 15th, what happens to, what if you owned the stock on June 2nd, the day after they declared a dividend? So they declared a dividend on June 1st. And on June 2nd, I own the stock, but the date of record is June 15th. So I sold it on June 13th. Number one, am I going to get the dividend? I sold it on June 13th, and my date of record is June 15th.
You're not going
Am I
to.
going to get the dividend?
No.
No. Why would an investor be interested in selling a stock that already they know they're getting a dividend? The dividend was declared on June 1st for date of record on June 15th and date of payment on July 1st. Why would you sell your stock when you know you're about to get a dividend? This isn't part of the exam, but something that inquiring minds ought to be wondering about. Why would you want to sell stock that you know you're about to get a dividend on?
Because dividends decrease stockholders' equity.
They do, but what does it do for? What are the two reasons that we buy stock? We want what? Dividends. And what else do we want, Peter?
Growth.
Growth. You want an increase in the market price, growth, and then you also want to get dividends. Those are the two ways that you get a return on your investment. So if you're about to get a dividend, why would you sell your stock in between the date of declaration and the date of record? Do you think that stock is going to sell for more than it would normally have because you're about to get an invest in a dividend?
Yeah.
Yeah. For those of you that are interested, there's a special place in the Wall Street Journal where stocks that are in between that date are called selling ex ante. And they're in a special place in the Wall Street Journal where if you're looking for stocks that are about to pay dividends and you can buy them before the date of record, that's where you look. That's what they're called. Okay? Just business information. You're in college, you ought to have just inquiring minds. It's a real interesting, thing to think about. So there's a very special place for them. There's a section in the Wall Street Journal where it lists the stocks where a dividend has already been declared, but the date of record hadn't happened yet. So just an FYI. Okay, so now let's go back and finish up the problem. So does everybody understand the 3 dates that are related to dividends? On the date of record, do I have a journal entry? Do I have to do a journal entry on the date of record?
No.
No. Do I need to do a journal entry on the date of declaration?
Yes.
Yes. I've got to do what? What are my accounts?
Dividend and then dividends payable.
Very good. Debit dividends and credit dividends payable. Once the BOD declares a dividend, it is a legal liability. And then what about the date of payment?
Dividends payable and then credit cash.
Good. Reduce your liability and then of course reduce cash because you're having to pay them. Good job on that, Claudia. And DJ, those who have added to that conversation. All right, now let's get back into the problem 10.9 and let's look at the last journal entry that we need to do. So I'm going to go back into sharing my screen and remember that we had purchased 6,000 shares of stock. I'm just going to make a notation here. Well, let me do it down here. Purchased 6,000 shares for, how much did we pay for our treasury stock?
65.
$65 per share. All right. Now, it is October 21st, and they sold some of their treasury stock. They sold 3,000 shares of their treasury stock for $70 per share.
Debit cash.
Good, debit cash. And I'm going to debit cash for, I sold 3,000 shares at $70 per share. So I got 210,000. I'm going to credit what? What did I sell?
Treasury stock.
Treasury stock. And how much am I going to credit treasury stock for?
The same amount.
How much did we buy it at? How much did we pay per share when we purchased our treasury stock?
$65.
$65. How much did we sell it for?
70.
70. Number one, whatever you put in treasury stock out, I put it in at $65 per share. I need to take it out at $65 per share. So I'm going to credit treasury stock for, I sold 3,000 shares. How much had I put it into treasury stock at? I debited treasury stock at how much per share?
65.
65. So I'm going to credit treasury stock at the same amount that I put it in, the $65 per share. So 3,000 shares is what I sold at $70 is where the 210 came from. Then the 3,000 needs to come out at the $65 per share because that's what I put it into treasury stock at, $65 per share. Now I can see that my journal entry isn't balancing, and I'm gonna pick on y'all a little bit if y'all don't mind me picking on y'all. I know y'all don't. Y'all love when I pick on you, I think. Is that journal entry balancing?
No.
No. Should our journal entry balance?
Yeah.
Yes.
Cool. We remember something from chapter 2. Yay. Y'all do. I like to pick on you. So I've got a credit account, an account for how much?
15,000.
15,000, right? Now, what account am I going to credit?
APIC.
APIC. Additional paid-in capital. Additional paid-in capital. Look on page 502. It began on 501, where you debit treasury stock and credit cash. And then 502 is when, the top of page 502 is when they sold it for more than what they had originally purchased it at, which is what it was in this case. So does everybody understand the October 31st journal entry? I'm sharing screen, so I'm expecting y'all to say something.
Yes.
Okay, if you're not, please, Dr. Bostic, where'd you get this number from? Now let me show y'all, it didn't ask you to do this question, but y'all are my smart class. Don't tell my intermediate students that. Y'all are my smart class. If this is not in the problem, but I'm making this up, what if on October, if I can spell it, Now, what is important about October 31st? On final exams, and I can write this in on an online exam as a write-in question, but on final exams, I am famous for asking questions like, you know how I just say, like lagniappe, something extra. Or I may say something like, do y'all know when my birthday is? Have I said that one? I'll just say different things throughout the semester, and then it'll show up as a question on the final exam, but as an extra credit question. I would never do it as a regular question because that's not fair. But I'll have an extra credit question where I'll ask random stuff. Here comes one that's random. What's important about October 31st?
Halloween.
It is Halloween. That's one thing, but that's not the most important thing to me.
Is your birthday?
It's not mine. Mine's November 14th.
Your husband's.
Not my husband's. I was raised by a witch. So what does that mean, Aiden?
Your mother's birthday?
It's your
Good,
mother's?
Jay. October 31st is my mother's birthday. I pick on her. I'm fortunate enough to still have my mom, and I pick on her and I tell her, I said, yep, I was raised by a witch. And she says, Lisa, I'm good as long as you don't put a B in front of it. So you never know what's going to show up as just those little lagniappe questions. Well, anyway, so on October 31st, what if the company sold $1,000 shares of treasury stock for $60? Yeah, that'll work. For $60 a share. Okay, so they sold 1,000 shares of treasury stock for $60 per share. And this is on page 502, still continuing with the transactions we learned in treasury stock. So how much cash did we get?
8,000.
60,000? Is that correct?
Yes.
All right. Now I know that I need to credit treasury stock for how much?
65,000.
65,000. Claudia, why?
It's the 1,000 shares times the initial 65.
Nice job. It's the 1,000 shares times the initial $65 that I paid for it. Okay.
And then wouldn't you debit the APIC for the difference?
And you debit APIC for the difference. And you debit APIC for the difference. Okay. Those of you that are changing your majors to accounting, you will learn some additional journal entries about treasury stock, but these are your basic ones. So now we've covered treasury stock. Now, how many shares of stock do I have outstanding? Remember up here, we had the 100,000 at the beginning of the year. And then on March 1st, we issued 65,000 more. And then on May 10th, I purchased treasury stock. Oh, that came to zero because I was using that as a cell reference. Well, I'll put it back. Oh my gosh, Lisa. I mean, and I'm really a really good Excel user, not proven it in a while. All right, so 159,000 is what we had. All right, then on June 1st, we declared dividends. On July 1st, we paid them. And then on October 21st, what did I do?
You resold the 3,000 shares.
I resold the 3,000 shares. Does that change my number of shares outstanding?
It increases it.
It increases it, exactly. When I reissue the treasury stock, it makes them outstanding. So I reissued 3,000 shares. And that was on October 21st. I will upload this solution since it is involving more things than just that exercise, okay? So on October 21st, and then on October 31st, what happened on October 31st?
Purchase 1,000 stocks.
Good, I repurchased how many shares?
1,000.
1,000. Oh, yeah. I repurchased 1,000. So is that going to increase the number of shares outstanding or decrease it?
Decrease.
So I put the treasury stock that I had purchased back, I resold them. So I put them back out in the market. So on October 31st, when I reissued them, is it going to increase the number of shares outstanding or decrease?
Increase.
Increase, exactly. How many shares do I have outstanding now?
163,000.
163,000. How many shares of treasury stock do I have?
2,000.
Well, let's take a look. The company, how many shares of stock has the company issued? How many shares of stock has the company issued?
165.
Nice job. 165,000. How many shares of treasury stock do they have?
2.
Well, how many did they purchase on May 10th?
6.
6. How many did they reissue back into the public on October 21st?
3,000.
3,000. How many did they reissue out into public on my mom's birthday?
1,000.
1,000. So how many shares of treasury stock do they have?
The difference.
Right, the difference. So if they had 6,000, they reissued 4,000. How many do they have? Come on, where is everybody?
2,000.
How about 2,000?
Yeah.
Oh, is that what you said? Good. I thought you said 3,000. So 2,000. Here's treasury stock. They purchased 6,000 of treasury stock. They reissued 3,000 shares of treasury stock. And then they reissued 1,000 shares of treasury stock. So if they purchased 6,000 and reissued 4,000, that means that they still have 2,000 And so if they have 165,000 shares of stock issued, they have 2,000 shares of common stock, of treasury stock. How many shares do they have outstanding?
163.
163. Does this number agree with this number?
Yes.
Yep. And if they were going to, say on November 1st, they declared dividends, how many shares of dividends would they be declaring dividends for? 165,000 or 163,000?
163.
163. So I've kind of asked the same questions, but in different ways to make sure that you understand the concept. Okay, so in exercise 10.9, we covered one, how do we record the issuance of when we issue common stock? This one had a par value. We looked at the journal entry of what is the journal entry when we buy treasury stock. Treasury stock has what kind of a balance, debit or credit?
Debit.
Debit. Why? What kind of an account is it?
It's a contra equity.
Good. It's a contra equity account. And how do I calculate the number of shares outstanding?
Not
Share.
minus treasury.
Good. The number of shares issued minus the number of treasury stock shares. When I declare dividends, do I declare dividends on the number of shares issued or the number of shares outstanding?
Outstanding.
Good. The number of shares outstanding. Do I take into consideration par value when I am recording treasury stock?
No.
No. No. The only time that we deal with treasury stock, par value is when we're issuing either common stock or preferred stock. It's the only time that we care about the par value is when we're either issuing common stock or issuing preferred stock. How we're doing, there's background noise somewhere. Vincenzo, do you have a question? Thank you for reducing the background noise. All right, now let's take a look at preferred stock. How do I calculate the dividends that preferred stockholders would get? And look on page 499. On page 499. On page 499, I know that y'all critically read the illustration that is illustration 10.9, and you understood the difference between how much preferred stockholders got and how much common stockholders got based on whether the preferred stock was cumulative or non-cumulative. Do you see on preferred stock that in illustration 10.9 on page 499, do you see that it says 1,000 shares, it has preferred dividends for 2021. And we're going to go over a problem that calculates the amounts right now for how much goes to each one. But what I want you to focus on right now is, how do I calculate the amount of dividends that each share of preferred stock should get? Because remember, they've got to be paid before common stock gets theirs. So do you see that it has 1,000 shares, which is, and the preferred stock was $30 par value, 8%. How you calculate how much dividends each share of preferred stock will get is to multiply the par value times that stated rate. So on the example on page 499, what is the par value of the preferred stock?
$30.
$30. And what is the stated percent?
8%.
8%. What is $30 times 8%?
240.
Or is it 240 or
2.4.
$2.40?
Yeah.
Right. Okay. Yeah. $2.40. So the dividends that this preferred stockholder would get for each share of dividends is $2.40. The par value times that stated rate. Okay. So how you calculate the amount of preferred stock dividends per share of stock is the par value times the stated rate. So in this case, the $30 times the 8% means that it is $2.40 per share of stock. And they had 1,000 shares is where they got the 2,400. Okay? So let's look at problem I'm going to find it, but they don't have one that's worth a darn. They don't. All right, I'm going to go into Excel and we're just going to make some numbers up and we're going to allocate how much goes into preferred and how much to preferred stockholders and how much goes to common stockholders. So let's assume, I don't need this much. So let's assume that a company outstanding common stock of 10,000 shares. Now this isn't issued, this is outstanding. So it means that I've already subtracted the treasury stock. And they have outstanding preferred stock, and the preferred stock is $15, 6%. And the $15 is the par value. And let's just say that they've got 1,500 shares outstanding. Notice I put outstanding. So let's just say this is the number of shares that a company has outstanding. And let's assume that at first, the preferred stock is cumulative. So how much stock would the preferred stockholders get each year if a dividend is declared? So how much would they get for each share of stock?
Are you meaning to share your screen right now?
Yeah, I was wondering why y'all being so quiet.
Okay, we can't see anything.
Just to speak out. Y'all laughing at me behind my back. That's okay. My feelings won't get too injured too badly. I think that's the one. Yeah. Now can you see it?
Yep.
Beautiful. All right. So they have, let's just assume that they have 10,000 shares of common stock outstanding. And this is 15,000 shares. You know, in stock, you have to be careful as to whether you're talking about the dollar amount or the number of shares. So here I'm talking about the number of shares outstanding. So they had 10,000 shares of common stock outstanding, and they had 1,500 shares of preferred stock outstanding. How much would each share of stock, of preferred stock, get for dividends? So what would be the dividends per share of preferred stock? $0.90. It's $15 is your par value times the 6%. So every time dividends are declared, the preferred stockholders would get 90 cents. Is my math wrong?
No, that's right.
Okay. So they would get 90 cents. So let's assume that it is cumulative. And then the total would be the 90 cents times the number of shares outstanding. So every time we declare dividends, I should have to give $1,350 to the 1,500 shares of preferred stock. The 90 cents per share times the 1,500 shares outstanding. Now let's suppose in 2019, I declared 3,000 in dividends. And let's suppose in 2020, I didn't declare any. And then in 2021, I declared 1,000. And then, whew, things got better. And in 2022, we declared 10,000 shares of common stock. 10,000 shares of dividends. So this is 3,000 shares of dividends were declared in 2019, none in 2020, 1,000 in 2021, and 10,000 in 2022. And let's assume that the preferred stock was cumulative. How much stock would go in each year to the common stockholders and how much would go to the preferred stockholders, assuming that the preferred stock is cumulative? So how much would go to the preferred stockholders in 2019?
3,000.
Well, how much are they entitled to, the preferred stockholders? Why would they get the whole 3,000? How much should they get per share, the preferred stockholders? How much should they get per share?
90 cents.
90 cents. And so if I do 90 cents times the 1,500 shares outstanding, how much has to go to the preferred stockholders before it goes to the common stockholders?
1350.
Good, 1350. So in 2019, my preferred stockholders would get the 1350, and then the common stockholders would get the remaining. Okay? Everybody good on what I did there? Now in 2020, no dividends were declared. So preferred is not getting any. I'm just trying to enter in. And common's not getting any. No preferred stock was issued. No dividends were issued. Sorry, no dividends were issued. Now, do I have dividends in arrears?
Yes.
Yes. What are my dividends in arrears in 2020?
The 3,000, right?
The 1350.
No, the 1350, exactly. The 1350 is the dividends in arrears, the amount that if dividends were declared that the preferred stockholders would get. And because they're cumulative, I need to keep track of the dividends in arrears, because when preferred stock is cumulative, when dividends are declared, they are entitled to getting the dividends that they missed from prior years. Okay? So now in 2021, I declared $1,000 dividends. Things were a little better. Who gets the $1,000? Preferred, common, or both?
Preferred.
Good. Preferred is going to get the whole $1,000. The common stock is going to get zero, because if dividends are declared, how much are the preferred stockholders entitled to get before the common stockholders?
1350.
Exactly, this 1350. I didn't even declare 1350. I just declared 1,000, so the preferred stockholders would get the entire amount. Now, this is cumulative, so do I have dividends in arrears?
Yes.
What is my total dividends in arrears now? Do I still owe them from last year's? So they have the 1350 from 2020. How much should they have gotten in 2021? Look at my formula. How much should they have gotten in 2021? How much are they entitled to every year?
1350.
Good, 1350. So I owe them the 1350 from 2020, the 1350 from 2021, but did I pay them some of the 1350 from 2021?
Yes.
Yes, 1,000. So what is my dividends in arrears at the end of 2021?
$1,700.
Good, the 1,700. The 1350 from last year plus the 350 that they did not get this year. They only got 1,000 of the 1350. So the 350 plus the 1350 is the 1,700. So now it's 2022. How much do I need to pay the preferred stockholders before the common stockholders get their money, get their dividends?
1350.
Well, the 1350 from 2022, plus do I need to pay them the arrearage from the prior years? So in 2022, they're entitled to get the 1350 from 2022, because remember that 1350 is each year. So they need to get the 1350 from 2022 plus the 1,700 that was dividends in arrears at the end of 2021. And then the common stockholders would get the difference. And then how much dividends do I have in arrears at the end of 2022? Zero. Because they got paid for, well, they got paid for 2019 in 2019, and then they didn't get 2020s. They only got $1,000 of 2021s, and then they got the whole 1350 from 2022. So I had to pay, by law, I had to pay my preferred stockholders $3,050 before the common stockholders could get their dividends, if the preferred stock dividends are cumulative. Let's see how different this would be if it was non-cumulative. So if it was non-cumulative, if dividends aren't declared in a year, do the preferred stockholders get it? If no dividends are declared, does anybody get any dividends?
No.
No. Do dividends in arrears even exist if it's non-cumulative?
No.
No. So they would get they would get the 1350 in 2019. Nobody would get anything in 2020 because no dividends were declared. What about this 1,000 in 2021? Who would they go to? Are they going to split them? They're going to...
Preferred.
Good. Preferred would get them all because it's less than the 1350. And common stock wouldn't get anything. Now, what about 2022? How much would the preferred stockholders get?
1350 and then
Exactly, 1350. And the common stockholders would get the remainder. So on non-cumulative preferred stock, when no dividends are declared, as in 2020, or when insufficient dividends are declared, as in 2021, the preferred stockholders are SOL. And that is an official accounting word. So I will put this up in Blackboard also so that you can understand how to calculate between how much common would get, how much preferred would get under cumulative and non-cumulative. Okay, so I will share that with the appropriate instructions since it's not at the end of the chapter. So chapter 10 is full of a lot of little different ideas about common stock. I don't think any one of them is that difficult, but it's just a number of things to remember about stockholders' equity. On Thursday, we will complete chapter 10. You are going to have a quiz in chapter 10 and 9. So you're going to have a quiz for chapter 9 and chapter 10. Chapter 9 was a chapter on what? And I will post an announcement on Blackboard since into class. What does anybody remember what chapter 9 was about? So 4-letter word, and it begins with B. Bonds. So start getting studying on bonds. I think bonds are probably going to be the most difficult topic, as well as the statement of cash flows, which we'll start with on chapter 11. Okay, so I want to keep you studying and going along so that you're not having to study, at the end, that you're feeling good with studying all along. Okay, Claudia. Oh yeah, no, we're ending class. All right, so I will put an announcement on Blackboard reminding you about the quiz and what we're going to be doing on Thursday. And then we'll get into chapter 11, which is the statement of cash flows. Another big statement, okay? It was good seeing y'all. We were able
Professor?
to apply in quite a lot. Yes, John.
Can I just ask you like a couple questions to clarify about the ethics assignment real quick?
Oh, sure.
For the memo, who should it be addressed to?
Me.
Okay. And then for our citations, like when we cite, are we just citing the Brown University?
Yes, I just want you citing particularly what framework that you use.
Okay, thank you.
And don't misspell my name.
Okay.
It's my husband's name, but if you can imagine how many times I have gotten an ethics assignment and your addressee, say it's your boss, and you misspell the name, it's just like bonkers. Are you going to misspell your boss's name and expect them to not fire you? I mean, it's my husband's last name. I don't care. But my last name is CK. It doesn't just end in a C. It doesn't just end in a K. It's CK. All righty?
Yeah,
So yeah, and please don't make it real long where I got to read a bunch. Business writing, get in, get out.
Sounds good. Thank you.
You're quite welcome.
Are we writing it in first person, like we're running the company, or are we?
No, you're writing it to me. You're writing it to your boss about this ethical situation you have found.
Okay.
So you just write it to me. But it's a memo, not an official letter.
I already wrote it, and I wrote it. I thought it was supposed to be to the shareholders. Like I thought you were the.
That's fine. That's fine
Okay.
too. Yeah,
right.
that's fine. Do not rewrite it. To the
Okay.
shareholders is fine.
Okay. Thank you.
You're welcome. Peace out.
Right.
Have a great day. Thank you for your time.
Oh, not a problem. Thank y'all. I love this. It's fun. And I had a granddaughter.